This topic's one I did not exactly want to jump into so soon, but it had to be discussed and be discussed right now. Be very, very careful when discussions about refinancing your home or rental properties come up, and trust me, they will, and in many cases, they already have. So start paying close attention to the ads you're going to see, and I'm sure you're already seeing them everywhere about consolidating your debt, getting a lower monthly house payment, or accessing some cash or equity from your home. And with interest rates on the decline, it can seem like a financial lifeline, but it could be the biggest mistake you ever make, so proceed with caution. Many homeowners are going to be lured in by the promise of lower monthly payments, quick cash, or a great way to consolidate debt. And before you sign on the dotted line, consider this. One wrong move could trap you in a cycle of even more debt and erode your home's equity, or even lead to a foreclosure. The stakes right now could not be higher, and when dealing with your home's equity, there might be a better way to go about paying off your debt without starting over on your 30-year mortgage or getting a home equity line of credit. So stick around as I discuss all of this, and I cannot wait to hear your questions and your comments. So if you're enjoying the content we're putting out here on the Complete Money Playbook, please subscribe to the channel, comment and like on the videos, and we'd love to hear what you have to say. So if right now you were to go and Google home loan interest rates, you're going to see all kinds of crazy, dramatic headlines about interest rates tumbling and plummeting. You're going to see things about stock market jumping around all over the place, and it's going to be a little volatile for the rest of the year. But do me a favor, when you're trying to fix your personal money and finance, don't watch the news. Don't read the headlines. It's just things that are going to drive you crazy. So let's try to figure out your personal financial situations. So first of all, there's many reasons you're sold and told to refinance your home. So let's start with the reasons not to refinance your home. Okay, so one of the main reasons why you might not want to refinance your home is it can be expensive. People don't think about what the closing costs are going to be when refinancing your home. And again, they're potentially pretty significant. They can range anywhere from 2 to 5% of the loan amount. And part of that depends on if you're just refinancing your loan or if you're doing a cash out refinance. That's when those fees can change dramatically. So if you're not planning on staying in your home for the long term, the savings that you might get from a lower payment with a lower interest rate may not outweigh the upfront costs. So it's definitely something we need to consider. And if you're not sure exactly how that works, reach out to me. We can answer the questions for you. The second one is extending your loan term. So when you refinance to a 30-year mortgage, yes, you might be able to lower your payment. But if you're someone that might be 6, 7, 8 years into your mortgage, you have to remember, if you look at a loan amortization schedule, you pay a giant chunk of your interest in those early years. So if you were to go to Excel, pull up a loan amortization schedule and start playing around with the numbers, you'll see at the beginning payment number 1 versus payment number 100 versus payment number 200 out of those 360 on a 30-year mortgage. At the beginning, it is a large chunk towards the interest and not as much towards the principal. So if you start that cycle over, it's one thing if you've only been in your home for a year or two and the rates have dramatically dropped. If you were someone who got an 8% rate and now we're getting into the low 6s, potentially we're going to drop below 6, makes total sense. But if you're 8, 10, 12 years into your mortgage and you're not sure you're going to keep staying in this house for too long, this is one of those reasons where it doesn't automatically just make sense. Hey, the rates are lower. Let's lower to a better payment. So another thing you have to worry about is prepayment penalties. So your existing mortgage might have a prepayment penalty if you pay it off early or refinance it. So it's just something to think about. Ask those questions. Typically, people will go back to the same lender that their current loan is through, which you don't have to do, but just know if that's something that's going to happen, because if there is a penalty, you want to know how much it is, and it might make it still worth it to do it, but just something you need to be cautious about. And then another item is people get concerned, is it going to be a negative impact on my credit score? And typically if you're applying for a refinance, yes, it is going to trigger a hard inquiry on your credit report. If it temporarily lowers your credit score, typically you're not looking to use your credit score other than to do this refinance because you probably have other debts and other things in other places. And I tell people all the time, the only reason you need a credit score and a high credit score is to borrow money. And ideally on this channel, what we're trying to do is help you get rid of all your debts. And the only time you would actually even need a credit score is if you were buying a house, and then we want a high credit score. But if we're refinancing, we're not looking to buy anytime soon anyway, so it really doesn't make a huge difference if there's a temporary dip in your credit score. So here's one that people don't think about very often. It is the risk of an actual increased interest rate. So you might have people like myself. I was lucky. I happened to refinance a rental house that I moved into 5 years ago, and I currently have a rate that's less than 3%. So when someone's trying to get you to do debt consolidation, part of the sell is let's say current rates were 6.25, is that you might have credit cards or car loans or student loans or some other type of personal loan that you're paying 15, 20 or more % on your interest rate on those loans. And so what they're trying to do is say, on average, if you consolidate all this this debt, your home loan interest rate might go from 3 to 5 or 6, but on average, you're actually reducing your overall total payments. So I'm not a huge fan of getting rid of your current really low interest rate on your house. this might be something where we can talk about here in a little bit about doing a refinance. You see these companies, I hear SoFi ads on my thing, on my car radio all the time about consolidating your debt and doing a loan that way rather than doing a refinance in your house. Another thing is the equity reduction. When you do a cash out refinance, you start taking equity from your house. You see a lot of gurus are always telling people, hey, especially on rental property, if you start to build up too much equity to go do a cash out refinance, take that money and go buy another rental property. And it's not a horrible idea. It's just you have to be very cautious and very careful. When you start reducing your loan to value and you have too much debt, you can over leverage yourself and you can cause yourself a big problem. Back 15 years ago, I sold lots of houses for people that basically got stuck in a position where they were upside down, and it's just not something you want to go with. So just be careful when you're using leverage too much. Another one is a break-even period. So the cost of doing the refinance, we want to know how much that's going to cost. So let's just say for argument's sake, it cost you $5,000 to refinance your house and you're only saving $100 a month on your house payment. Well, that's going to take you 50 months or a little over 4 years in order to recoup that money. And if you don't have a plan on staying in your house for the long term, again, another thing that may just not make sense, and you might be better served just paying a little extra on the current house payment that you have to make sure that you're doing the right thing there. So another item that people don't think about sometimes is the complexity and the hassle. If you remember when you bought the house in the first place, there's going to be lots of extra paperwork, appraisals are going to ask you for all kinds of documentation. And again, if your financial situation has changed from when you bought the house, it's possible if you went to try to buy the house you live in, you might not actually qualify for the loan. So you may not actually qualify for a refinance. So just know it can be a little bit of hassle and a pain in the rear, and you do have a potential for higher payments if you refinance into a shorter term. So for example, I see people go from a 30-year to a 15-year, which potentially can make your house payment more. But for people, I think that's kind of a benefit for a lot of people, because potentially if your house payment only goes up a little bit, but let's say you were 5 years into a 30-year mortgage and you were able to get the term down at 15 years, then yes, your payment might be higher, but you get your house paid off a lot sooner and overall pay a lot less interest. Now, because people like me, my income is volatile, I don't get a paycheck every 2 weeks, a lot of times it makes sense to just stay on the 30-year mortgage and pay extra. That's what I like to do. But for some people, if they're more disciplined and they know they're getting paid every 2 weeks and they want to go from that 30-year to 15-year, yeah, your payment could get bigger, but as long as you know what you're doing, then you're going to be fine. Okay, so this is the last one of my original list of why you might not want to refinance your home. It is possible loss of some of your current loan's features. So some mortgages have favorable terms such as being able to make extra payments without a penalty, and refinancing could lose those benefits. So you just have to know that if you go to a new loan, just make sure the terms, what you're allowed to do with your loan. Like I had a loan on a commercial building once where we had two loans. One I could pay off early, the other I could not. And of course, the upfront cost of that loan was a lot less expensive because they knew they were going to make their money long-term on the interest paid to them and not on the fees charged up front, which worked out great for us at the time. Whatever your current loan is, if you're not sure what to do, if you're not sure if you have questions about it, reach out to me. We can get you in touch either with the lender that you're already using or a new lender to make sure that you get the best refinance that you can. So if you're someone who's thinking about trying to improve your money and finance situation, go check out our website at thecompletemoneyplaybook.com, where you can get in contact with me and we can help you figure out your money and financial situation. So now let's flip the script and let's go the other direction. Let's say, here are reasons why people want to refinance their homes. And of course, number one is that lower interest rate. So if you can get a lower interest rate and you can save on your monthly payment and over the lifetime of the loan, again, if you go to that loan amortization schedule and see how much less interest you're going to pay over the lifetime, it absolutely makes sense. It's just like when you buy the house, you just got to make sure that you're being smart about it. And of course, it leads right into, it will reduce your monthly payment. So a lot of times I tell people, if you're used to making the old payment, refinance into the new lower payment, and then keep making the old payment that you used to make so you can add extra each month to start paying off your total overall debt and make that 30-year mortgage a 20 or 15-year mortgage over time so you can pay it off that much sooner. Okay, another good reason why you might want to switch is if you're on an adjustable rate mortgage. And I know recently in the last few years, a lot of people bought homes on an adjustable rate or did rate buy downs, and they're not in this long-term fixed rate situation. That would be a fantastic reason to get you locked in to a rate. And right now you might be able to get that rate even lower than where you started before. So no, that way you have that predictable house payment every month and not having to worry about it adjust. Another reason, of course, is accessing your home's equity. And I always say, be very careful, like we talked about. If you're going to access your home's equity, what are you using the money for? So let's say you're someone that's in an older home and you're going to do, upgrades, you're going to get a new roof, you're going to start doing things to fix up your house. And I think it's a great thing to do. But for a lot of people, as their home's value has gone up, they start stealing the equity out of their house to pay for consumer debt like credit cards and cars and other things that really they're just living beyond their lifestyle. So on this channel, we're going to talk about budgets and managing your money properly. If you're going to do a cash out refinance to pay off debts, I'm not as huge a fan about that. We're going to find other ways for you to pay off your debt without having to refinance your house just to do that. So we'll talk about that more on a different video. So another positive reason would be if you want to shorten your loan terms. You're on a 30-year mortgage and now rates have dropped enough where you might be able to have a similar payment and discipline yourself to make that 15-year mortgage payment. You can. I prefer the flexibility of just keeping that lower payment on the 30-year and just paying extra every month, but just know potentially you can shorten your loan term. Another reason to refinance is removing PMI. So PMI is private mortgage insurance. It's for people that initially when they bought their home didn't put at least 20% down. So you're paying an insurance policy to make sure that the lender is covered with insurance. So if for some reason you defaulted on your loan, you got foreclosed on. I know there's lots of ways to get your PMI removed without having to refinance your home. So if that's just something you're looking at doing, reach out to me. Even if you don't live in the Reno, Northern Nevada area, I can put you in touch with a realtor in a different part of the country that can get you in touch with someone to get that PMI pulled off. So not a problem there. Why people do this is called consolidating debt. I'm not a huge fan of pulling out your equity out of your house and consolidate debt. So don't do it, in my opinion. We can talk about other ways to get your debts paid off besides refinancing your house. Another real good reason to why you'd want to do this is you can improve your loan terms. So not only have credit interest loans come down or interest rates come down, but let's say you're in a much better position where you're making more money, you have better credit scores, you might be able to even get the rate even lower than where it might be for somebody else. So it's another good move in that refinance if we can get that rate even as low as possible. Renegotiating your loan conditions. So some refinance can allow you to renegotiate your loan conditions, potentially get your current financial situation a little better by removing, say, a co-signer or another person. As an example, again, when my son first got out of college, we helped him buy a house. But when he graduated, he played sports. He didn't even actually have a credit score. So we had to co-sign on the loan with him. And after he had a job for a year, we were able to pull ourselves off. So then that way he's building up his own credit, his own score. And so for a lot of people, especially if you're helping younger people buy a house, it's sort of a great way, especially now as rates have come down and someone did this in the last year or two, to refinance, let that younger person have that loan in just their name and you can pull yourselves off. So that way for me, like if I wanted to go buy another rental property, it just shows I'm not part of that loan. So that's something that we can talk about as well for those of you that have helped people and you've co-signed for them to buy property. And the last one we want to talk about is taking advantage of the market conditions. The housing market in your local real estate area maybe has improved. And if refinancing can better your loan terms, better your situation so that you can maybe have a rental property that will work and you get that payment down. It's something I'm going to do. I bought a home about a year ago, and at the time rates were like 7.25%, 7.5%. And if all of a sudden I can refinance that home that I've only owned for a year into a 6%, maybe even lower rate in the next 6 to 12 months, I'm definitely going to do that. So you have to talk to your local people. And if you don't know someone, reach out to me. We know people all over the place. So there's a lot of times where it is very smart to refinance your home, but other times it is not. So just know you're going to see lots of ads. You're going to see lots of commercials. You're going to see them hammering you on because the rate is lower. You should always do this. And it is not always the case. So just make sure you're talking to the right people so you can make smart decisions before you refinance your home. So if you're someone who's looking for more information about trying to figure out how to get out of consumer debt, check out this video we did so that you can better your financial situation.